Welcome back to SF Live. My name is Kai Hoffmann. I'm the JR Mining guy on Twitter and the CEO of the Soar Financial Group. Thank you so much for joining us for another sort of wrap up interview for the year. Doing a bit of a review series here, 2022 in the rearview mirror, looking outward, of course, to 2023. It's been an insane year, so trying to wrap it up and trying to put a bow around it is extremely difficult. I'm struggling. I know my guests are struggling with it because I've chatted with them before we hit record, obviously. And we have a great lineup for you in terms of like lineup or SF Live review interviews. We just spoke to Andy Checkman and Rick Rule last week. I'm here with Lawrence Lepard. He's holding here in a holding pattern for a couple seconds, and then we have Doomberg coming up. We got Dave Collum,
Oh, awesome.
Jim Urio. We got Alistair McLeod also waiting. So great content. So make sure to subscribe to the channel, hit that like and subscribe button, and let us know what you think. How was 2022 for you? What did you think would happen? How were you positioned? And how are you positioned maybe for 2023? Leave that in the comments below. We do want to hear from you. Now, let me bring my guest on. And Larry, it's great to see you again. And I hope you had a
Likewise, Kai.
great
Thank you for having
Christmas.
me on your show. I'm wondering, how did I get in with all those really smart guys?
No, you're definitely part of it as well. Like I've always enjoy our conversations. Last we spoke was in New Orleans only, what is it, 10 weeks ago, a couple months ago here, mid-October.
Yeah.
So maybe we start. No, I actually want to start off with a banger, Larry. And I had to think
Okay.
of you. I think it was yesterday. And Mark Cuban was on a podcast hosted by comedian Bill Maher. And the quote was that was put everywhere on Twitter is like, if you have gold, you're dumb as F. Right. And what do
Yeah.
you make of that? Because I know you're in both camps, the Bitcoin
Oh,
and the
yeah.
gold
I
camp.
mean,
So
that kind of stuff is so annoying to me. I suspect he was saying that in the context of being a Bitcoin bull, right?
yeah,
And
to both.
yeah, and so I've said this many times. I mean, they're two different assets. They both have some similarity in the sense that they're really the only two assets in the world that don't really have counterparty liability. When I say gold, I lump gold and silver together, right? They're kind of the two monetary metals, and then Bitcoin is digital, a digital secure asset. And so, they both do not have counterparty risk. That makes them valuable. They're money outside of the government, et cetera, et cetera. The governments are out of control, and so the people who invest in each area have the same thesis, which is that fiat stinks and is going to be continually debased, eventually possibly to worthlessness. Look, I mean, there are Bitcoin people who say gold people are idiots. There are gold people like Peter Schiff who say Bitcoin people are idiots. I mean, gold is analog sound money. It has been for 5,000 years. It will continue to be. It's not going away. 6 billion people know that it's money. Bitcoin is digital sound money. It's an enormously important development. I mean, we created digital scarcity, legitimate digital scarcity, and that's the development there. And so it has the potential to be a digital form of gold, and with all the natural advantages that digital things have, they can move quickly and you can transfer large sums for small amounts very quickly, where it's very hard to send $1 billion of gold from point A to point B. Bitcoin's got some advantages, and I actually think it'll be quite successful. And I'm a bull on Bitcoin. Having said that, I'm also a huge bull on gold because, the world has run on gold for a long time, and things that changed in society don't change overnight. And so, to get to the point where Bitcoin is much larger and more important, both of these assets are going to benefit hugely in the coming devaluation of fiat currencies that we have. And really the biggest difference, I think, in terms of, day-to-day investing characteristics is that, Bitcoin is extremely volatile, as we all know. I mean, Bitcoin's had multiple 70 to 80% drawdowns. And the average investor has a very hard time dealing with that. That's not what they're used to seeing. If they buy something at 68,000, see it go to 17, they freak out, they sell it, which is sad. And gold, the largest drawdown I'm ever aware of in gold is like in the high 20s, and that's very rare. Generally, most years gold is up, some small amount like it is this year, or single digits, sometimes double digits. So, the volatility in gold, because it's more widely distributed, been around for 5,000 years, is just much lower. And so that gives it a big advantage to somebody who's trying to preserve their purchasing power and doesn't want to go on the roller coaster of big price ramps and big price drawdowns. Now, those will change over time, but until they do, gold has a place in everybody's portfolio. That's
oh,
my view.
absolutely. It doesn't
Yeah.
feel like the Bitcoin market is mature enough yet. If you look at what
No, not at all. Not at
FTX,
all. Now,
Binance,
it's got a
so
lot of alpha, and I also, I mean, to people to the gold people who say Bitcoin's junk, I said, no, you got to study it and understand what it really is. And I think there's a lot of upside in Bitcoin, and I think, people can be afraid of it, and it is volatile, but I think a zero allocation to Bitcoin for gold people, I actually think that's a mistake too, because I do believe that over a longer period of time, it's going to multiply in value quite substantially. So
Yeah, just like I'm actually fairly neutral on it personally. It's like I think they can both coexist. Like if we're in a
oh,
digital age,
absolutely,
like so I do see the
absolutely,
sense of it. Like I'm paying everything with credit card. Why not have a digital currency? So
absolutely.
I sort of get that, right? Let's talk. It was like I tried to open Pandora's box for 2022 a little bit with talking,
And
trying to throw
that's a hot topic.
right?
Yeah.
Trying to throw the FTX collapse in there as well. But if we were to review a little bit for 2022, is there like one word that comes to mind for you? Like that sort of sums it up for
Well,
you?
yeah, it's a shit show, right? I mean, for sound money investors. I mean, look, my fund's down in the mid 30s, year to date, maybe approaching the low 30s because this month's going pretty well. But, I mean, I said to a friend, I didn't have Jerome Powell trying to pretend that he's Paul Volcker on my bingo card, right? I mean, I thought the Fed would clearly, I mean, we had massive inflation. They finally admitted it. It wasn't transitory. They were wrong. They blew that call, et cetera, et cetera. And I thought, all right, they'll start to tighten in a sensible fashion, and, they'll give upward guidance, et cetera, et cetera. I didn't have the notion that they were going to hit the brakes so hard that, as El Arian says, the economy goes through the windshield. And that's kind of what they've done. I mean, this is one of the fastest set of rate hikes in history. And it's really, it hasn't impacted the economy that much yet, but it's going to. And you can't take rates from 0 or 1% up to 4 or 5% without having a lot of things happen that are going to play out over the next year or two. The biggest of which I think is kind of the death spiral that the government is being put into. I mean, if people examine the government finances, the U.S. government finances, of course, the U.S. government controls the reserve currency of the world. And you see that the interest expense has gone from 5 years ago it was probably $200 billion a year. A couple of years ago it was $300 billion a year. Now it's running at $750 billion a year and going higher as rates continue to increase. I mean, this is a big problem, and so government deficits are going to continue to expand. The only way to finance those deficits will be to issue more debt. And my belief is that Powell has not pivoted yet, but he is going to be forced into pivoting because the Fed really has three mandates: full employment. Okay, we're close there, and they've accomplished that more or less, or they had accomplished that. Inflation under control. They're failing miserably there, and they know it. That's what they're trying to get their arms around. But the third unwritten mandate, they've said it in a lot of things, but it's not in the congressional piece of the mandate, is financial stability and a functioning financial system. And they will throw out mandate 1 and 2 when mandate 3 rises to the top, as it did in March of 2020, or as it did in September, October of 2008, or even to a degree as it did, with the dot-com collapse back in 2000. And so, what they've done with interest rates is going to change, is changing the way the economy is working, and is making the government get deeper in a hole. And as that becomes more and more apparent, things will start to break. And as things break, they will have to pivot. And eventually, Kai, what's going to happen, in my view, is the world is going to come to the conclusion, as you and I and most gold and silver and Bitcoin investors have already come to the conclusion, but the rest of the world is going to come to the conclusion that they can never stop printing money. They just can't stop printing money. The reason they can't is purely the mathematical way that a debt and credit-based system works. If you don't continue to grow the system, it collapses. And I think at the end of the day, they don't want it to collapse. They won't let it collapse. Before it collapses, they will print. And so, that's kind of what we're all waiting for, are the signals and the clues that they're getting closer to that. And to be honest with you, if you look at the gold and silver charts right now, they look pretty healthy, pretty constructive. I kind of feel like the bottoms might be in. And I remember back in 2019 and 2020, even before the big prints came, gold and silver kind of smell it out in advance. Do you know what I mean? They kind of look around the corner. And so I'm quite encouraged by the charts and the way they're kind of shaping up. And I feel like it's probably going to happen in Q1 or 2 or 3 of next year. They'll say, okay, we've stopped, we're stopping our raising rates. And then they'll say something along the lines of, yeah, if the inflation target's perhaps a tad higher than 2 for a little while, that's okay. And, then eventually other things will happen and the government deficits will get larger, and maybe the 10-year bond will start to go much, much higher, which compounds the problem, right? I mean, the higher the interest rates are, the more the government has to pay on its debt. And then, the more they pay on their debt, the bigger the deficit is. The more the deficit is, somebody's got to buy that. And that means the debt market gets saddled with buying those bonds. If there are no buyers, then to set the price has to go higher. And I guess where I'm leading to is eventually you get into kind of the Japan trap where you have to do yield curve control and you have to start buying your own bonds. And of course, that's printing money, which they're not right now. They're not printing money right now. They're not theoretically, in practice, they really are doing QT. I mean, their balance sheet is shrinking. So, but you can see how this is going to reverse. And I think when it does, just to kind of summarize the whole thread there, I think when it does, gold's going to go through 2070, silver's going to go through $30, Bitcoin's going to go higher, etc. And, and it's going to be game on for our stuff, right?
Absolutely. Like your stuff, we're talking gold and silver mining stocks primarily, obviously, some
Yeah,
physical gold and silver.
yeah,
Like 2022, of course, my portfolio has been hurting. You said you were down 30%. I think I'm not far away from that either. I'm right around there as well. What did you learn? Like, or could you have done anything different, or would you have done anything different now knowing what had happened? Like, because it
well,
feels
yeah,
like in hindsight, if you look at the rate hike cycle, if you look at it, like the rate hikes, they were somewhat predictable. Was it foreseeable that the miners, because as soon as the Fed started raising rates mid March, like the wallets and the purses of the investors went completely like shut completely, and were closed
yeah,
off. Financing market really dried up. So it was somewhat predictable looking at it. And would you have done
yeah. I
anything
mean,
different?
no, well, I wish it was more predictable to me. I sure didn't see it. Because I'm
Oh,
always a bull. So when gold went up to 2070, kind of off the war stuff, I thought, okay, here we go. And of course, I was wrong, and it came back in severely. But oh, I don't know. I mean, in hindsight, sure. I mean, I have three buckets of investments in the miners. I mean, I have the producers, the developers, and the drill stories. And the producers all make profits and cash flow, and they've done the best on a relative basis. I mean, in terms of how far I have producers that are up this year to date. I have some that are slightly down, but and not many that are down 20 or 30%. But of course, the development stories and the drill stories, which are more sensitive to the gold price and the outlook, some of them, and good companies too, not piece of shit companies, really good companies, are down 60 or 70%. So, yeah, I mean, if I had it all to do over again, I wouldn't have been, I was probably a third, maybe in those three buckets. I'm just, really generalizing here, but I probably would have been much more heavily producers and lighter in the development and drill stories, right? I mean, but I couldn't foresee, I was of the opinion that the Fed, while they would try to calm down inflation, they wouldn't go full Volcker like they've done because, I don't think Jay Powell has realized this yet, but I think what he's done is he's maybe trying to get, the inflation's coming in a bit and maybe he's kind of stabilizing things. He's definitely taken the frenzy out of things like FTX and the crypto market. By the way, all crypto is bullshit except Bitcoin. I mean, I don't even call Bitcoin crypto. Crypto to me is generally fraudulent. Bitcoin is the one technological innovation. I think it's an important point to make. But I mean, what Powell has done, he's taken the froth out of the economy, and that's fine. But he's got to be careful here because, taking the froth out is one thing, but shutting it down is going to create a whole different set of problems, right? I mean, the housing market right now with, 7% 30-year market or 30-year mortgage rates, and the car market is getting hit pretty hard, and it won't be long. I mean, we're already starting to see the first inklings of layoffs and so on and so forth. And by the way, inflation is not really coming down that much. I mean, he thinks raising rates will bring inflation down. Well, not entirely true because some of the inflation is supply chain driven and labor driven. I mean, labor costs have now kind of started to go up pretty consistently in the 5-6% range, which is an issue. So, it's a really tricky environment, Kai. I mean, anybody out there who's suffering or confused, I mean, the experts are right there with you. I mean, I think the best thing we can all do is, know what we own, know why we own it, be patient, and I know that having sound money stuff makes sense in an environment where the government truly is out of control. I mean, they really, the way they printed as much as they did and the COVID thing, the way they kept it as loose as long as they did, I mean, it was insane, right? And then they turned around and slammed on the brakes. I mean, harder than ever. And now we're going to crash into the other guardrail. So it's a mess, and it makes it extremely hard for business people, for investors, for all of us. I mean, and I think probably my one piece of advice to everybody is just don't use leverage. in an environment like this. I mean, you probably all see, everyone listening to this has seen the Weimar chart that Dan Oliver did, the price of gold during the Weimar hyperinflation. I mean, in these kinds of monetary events, monetary failures, things are going to be very volatile. I mean, go look at a chart of lumber. It looks like somebody's having a heart attack. I mean, it goes crazy in one direction, it goes crazy. And I mean, imagine trying being in the lumber business and, as you'll recall, a year ago, there were, bidding wars for houses, right? And right all over the United States. And now houses are sitting on the market for the longest ever. I read recently. So, it's really, it's a crazy, crazy environment. And it just shows how broken the Federal Reserve, central banking, credit creation model is. And that ought to tell everybody something, that if their model is breaking, you want to be out of their system. And the exit doors for their system are gold, silver, and Bitcoin.
No, I have to real assets, right? So
Real assets,
where is
right.
that breaking point though? It's like I'm looking at, you mentioned full employment. I think we're still there, 3.6%
Close, yeah.
roughly, right?
Yeah.
3.5 for me in my books. That's full employment.
Yeah.
Inflation, we're sitting around 7%, I think.
Yeah. And coming down though. Yeah.
But mortgage rate or interest, like I think mortgage rate is the key one here for me, because I have friends here in Germany as well. They're holding off buying a house because the interest rates just spiked, or mortgage rates, right? So I don't know. I'm just looking for that breaking point, because
What
that's
will
the same
break?
as
Yeah.
Powell, right? So
I think the biggest thing that's likely to break, in my opinion, the thing that I watch the most carefully is the bond market. And the future swaps on inflation. I mean, I think, and the stock market too, the US stock market. I mean, I think, what I see out there, I mean, you're always investing, you've got to kind of find the deviant perception, right? What do you think that the rest of the market doesn't know? And then you get in front of it. And when they figure it out, you'll make money, right? To me, the deviant perception right now is, I think everybody kind of believes that inflation is going to trend back lower to 2 or 3%, and that what Powell's doing will work, and that the economy won't break. I mean, there's a lot of propaganda about that. And that, we'll just go back to the way things were pre-COVID, and low inflation and a healthy economy and growth and all that sort of stuff. And I just don't see that as being a realistic possible outcome, partly because of the way, the inflation has gotten into labor costs, partly because of the way it's gotten into all the supply chains, you name it. And I think we're looking at something that looks much more like the 70s stagflationary kind of stuff, where, the price of, the prices of the things you need go up and the price of things you own go down. Housing prices are soft, et cetera, because of the cost of interest. Everything you buy with leverage, price of that might go down a bit, but everything you need, the price is going to go up. I mean, it's not as though we're getting more shale oil, which really kind of saved us in the last cycle. It's not as though the Saudis are saying they're going to pump more. Part of the way we got through this year as well as we did is we drained the shit out of the Strategic Petroleum Reserve. You can only do that for so long until you get down to too low a level. So I think, Tavi Costas got on Twitter, has a great set of charts that show the 70s, and you kind of, inflation comes in waves, right? And if you see the 70s example, it went up and then it came down, and we're in the process right now of it's coming down for sure. I mean, things are, they've taken the boil off the pot by all these high interest rate hikes, but it's not going to go back to 2. And so, if it goes back to 4 or 5, well, the 10-year right now is in the 4s. I mean, you're going to need, if inflation gets baked in at 4, the 10-year needs to be a couple points higher, which means interest rates need to be higher. And I got to tell you, from what I can tell, given how leveraged the government is and the economy is, I don't think we can live with 6-7% interest rates. I mean, I think things really start to blow up. And, I mean, you're seeing it in the periphery. You see it in Credit Suisse. You see it in England. I mean, I thought the England case this summer was a very important case study, right? They said, we're going to cut taxes and we're going to raise spending. And the market said, no, you're not. we're going to sell the pound and we're going to shove your interest rates up high. And then the conservative pension funds that are supposed to be just literally clipping coupons and being safe, turns out they're doing liquidity-driven investing, and they're all levered to shit, and they're about to blow up. And they used to call up the government and say, hey, change this policy, and get these things under control, we're going to blow up. And so, to me, that's a canary. And another canary is, I mean, as we were talking about before, Japan. Okay, we're going to keep our 10-year locked at 25 basis points. Oh, no, can't really hold it there. We're having a hard time with that. Well, let's go to 50. Well, 50 is going to become 100, and so forth. So the credit markets, in my opinion, will be the clue that shows, and the stock market by extension. I mean, I still am shocked that the US stock market is only 20% off its all-time highs. When its all-time highs were way, way above trend line. Now, the ARKs of the world are down, as we discussed, 70%, the super high beta stuff, but it's going to filter into everything else. I mean, 20, 30 PEs, those don't work when you've got 6, 7% interest rates. You just, people have an alternative now, and we got to those PEs because interest rates were suppressed, right?
No, exactly. Like, let's try to get 2023 into the conversation a little bit, because
Sure.
it's sort of a mixed conversation here already.
Yeah.
But how are you sort of future-proofing your portfolio based on the lessons learned? Like, are you hedging? Are you adding other products to sort of offset possible disasters?
No, I mean, we've got a pretty clear mandate to be in these, these alternative forms of money. I mean, we've been buying, we're buying across the board. I mean, we're probably a little heavier producers, just because we want to make sure that we've made the turn before we pile into the drill stories and the development stories, which have more risk but more reward. I mean, they're dependent upon higher prices to work. We always maintain a little bit of cash. I mean, from time to time we'll do some, we'll do a little short selling. I'm talking like 1 or 2% of the portfolio. So, in terms of the timing on it, I think that's probably part of what was in your question there. I mean, the Bear Stearns funds blew up in the summer of 2007. That was the first, the CDO squared kind of crap going south. And I was active back then. I was investing. I was short a lot of that financial stuff because you could see it was a bubble. I had the Michael Burry trade on. I didn't realize what a CDS was. So I wasn't big enough or smart enough to go do all that. But I was short Lehman and Fannie and Freddie and MBIA and all those guys and, Bear Stearns. And, the stuff started blowing up in the summer of 2007. But the crisis really occurred in September, October of 2008. So if you look at the lag there, that's over a year, maybe approaching a year and a half, right? And so, I kind of think they slammed on the brakes. The Fed really started getting aggressive. Well, the Fed first raise was February of 2022. So, but then they got, everyone was like, oh yeah, fine. We knew they had to raise rates, but then they got pretty aggressive about it a few months later, in kind of, April, May, June. And so, if you extrapolate out and you kind of think it takes time for things to filter through at the end of one of these things and see changes, it's probably a year and a half. So I think that kind of puts us in Q2 or Q3 of next year. I think things are really going to start to break. And you've already seen it. I mean, and I remember this reminds me of 2000. In 2000, when the dot-com bubble burst, the real high flyers burst first. And it wasn't until almost a year and a half, 2 years later that Cisco got taken out and Microsoft got taken out and shot. And as you recall, in 2000, the overall market went down 50% in 2000, top peak to bottom, the S&P. I mean, that's the broad market. And that bubble was just focused on the tech stuff, right? And the dot-com stuff. But, the high flyers went first and got shot, starting in March of 2000. And then everything else, the bottom of that whole one was kind of late 2002. So it really took, almost a full 3 years, 2.75 years for you from top to bottom, at the peak to the bottom. And so if the US stock market peaked in December of 2021, which it did, and we're now 1 year later into this whole game, the stock market's down 20%. I mean, I tweeted that the other day. I mean, there's just no way that, I know a lot of people say, well, the bull market is going to come back, buy Tesla here. It's all good. Things are, the clouds are clearing.
Has been getting very quiet, actually.
Yeah, right. I mean, yeah. And by the way, the buy the dip crowd got positive reinforcement from 2008 to 2022. I mean, it was crazy. I mean, they had this enormous run of no matter what happened, buy the dip. And, okay. And they're still in there kind of believing, it's 20% off the peak, but it's going to come back. Well, I'll take the other side of that bet. The market, that peak in 2021, that's going to last for a while.
Counter thesis. You said we'll have to get back to printing money.
Yeah.
So is that when we buy the dip? Right?
Well,
it reminds me of
I think we'll get back to printing money, but I don't think, I think in the initial parts of that, it won't help. Because I remember when they started printing money in 2000 and they started printing money or 2001, and so to speak, and they really started printing money in 2007 or 8. And it'll take a while. I don't think there's any rush. Let me put it that way. And the whole thing, oh, we'll print money and the market will roar on to new highs. I mean, I suppose possibly if we get into kind of a crack up boom sort of scenario, but I tend to think that no, it's the printing money is not going to solve the problem this time. It's going to make the inflation worse. That's going to make the interest rates worse. And honestly, I think this will be the time when what will happen is, people are going to realize that our stuff is where you got to be. Because and I think I've said this in another podcast, I said it recently. I mean, I actually think we're looking at a mania in silver and gold mining stocks sometime within the next 5 years, arguably within the next 2 years. Because let's just hypothetically, in 2023, I think the US stock market will go down another 20 to 30%. And in 2023, I think the metals will break out, and the metal stocks, as you know, are extremely depressed and could easily go up 50%. And if there's one thing that happens in markets that I've observed over time is that people chase performance. And so, you're a US fund manager, your base market is going down and is losing people money. And you see this other category over here, gold and silver mining, that is performing extremely well, and copper and oil and gas and other commodities related. I mean, it's all the same theme, right? Real asset-based companies, right? And you see them working, and what are you going to do? You're just going to go pile on. And and these things are very cheap. It's not like we're talking enormous multiples of cash flow or enormous PE ratios, or the miners have been very disciplined. They haven't taken on a ton of debt, and we've underinvested in mining for a long time. Tavi has a great CapEx chart that shows, nobody's been there've been mines built, but very, very few. So I think that's going to lead to a mania in our stuff. Now, the trick there will be, there'll be some swings up and down in that mania, and I'm not sure we want to overstay our welcome. When we get massively paid here, and sadly, what will happen is a lot of people will pile into it at the top, right? Like they tend to do, just like they piled into ARK at the top, right?
I'm still waiting to meet a Bitcoin buyer at 64,000, by the way. I keep saying but I haven't met anybody yet, though. Nobody's raising their hand and said, I did it.
I added some at 64, but I had a lot that I bought lower. And yeah, there's a dollar cost averaging, to these volatile assets that makes sense. But yeah, no, there's, and by the way, I think it could run for a while, because I do think that the financial issues that we face, they're not going to be just addressed quickly. And arguably, they could completely lose control of the whole machine, and we could go to some kind of a hyperinflationary event, and we could end up with all the marbles. That's what I dream about.
But that would get rid of the debt.
And I think there's a real possibility of that, but I never want to predict that, because I don't want anybody putting all their marbles in this basket, because it's a risky basket, right?
Oh, absolutely. But the hyperinflationary, scenario would help debase the debt, right? And like we've seen in Weimar, that was the.
Yeah, they've got. Look, we know mathematically they have to either have outright hyperinflation, which will solve it, which would be horrible, but would solve it quickly, or they need consistent inflation over a longer period of time to debase the debt relative to the size of the economy.
I can't remember. Maybe it was us chatting, but maybe you said it. It was 8% over 40 years to get rid of the current debt.
Yeah,
to inflate out of it. We might have had that conversation, right? So
it wasn't you and me, but I've heard numbers like that, and Luke Groman has come up with numbers like that. I think the more likely event would be 15% over a shorter period of time. A 70s like very inflationary environment that gets so bad, with so many people screaming and yelling about how awful it is, that somebody says, okay, we've got to return to a sound money standard here. We're going to back the dollar with gold or whatever, Bitcoin, something. Unfortunately, I don't think they'll go for Bitcoin, because it's too undeveloped. But they definitely need to devalue the dollar and reset to a sound money standard, in my opinion, if we want to have economic growth on a sustainable basis.
How about a curveball? Let's talk about CBDCs for a second to wrap this up
here.
Yeah. What do you think of that? Like central bank digital currencies, a new US dollar?
Yeah. Well, look, the whole notion of a digital dollar, great. And a CBDC, I understand what it is. In a way, we really kind of already have CBDCs in the sense that, nobody really handles dollars anymore. Everybody has digits in their bank account, and we've got a million payment rails, we got credit cards, we got PayPal, we got Venmo, we got all kinds of things. But the government could come along and say, hey, we're going to have government coin, and here's $1, and we're going to, when you pay your taxes, you got to pay them in this, and maybe when we do universal basic income, we're going to pay you in that. And of course, as we all know, the danger of that is that they could see, theoretically, they can see that account, they can control that account, they can say, hey, Kai, we noticed you went to the pot store, you can't go there with this money, that kind of stuff. So they could create a social credit score on you and watch and everything else. So I think it's extremely dangerous and evil. I think it's possible and likely that they'll try and go there. I will say this from a Bitcoin person's perspective: there's no way in hell any Bitcoiner is ever going to swap their Bitcoin for a CBDC. I mean, a CBDC is really just a central bank controlled dollar. And what's the limit on the issuance? I mean, the underlying problem with the dollar is that the issuing authority, the U.S. federal government and the Fed in tandem, because they really do work in tandem to create credit and keep the banks liquid. The issue is that those two authorities, do not have a break on their spending or their money printing. And as a result of that, the rest of us who have money earned that we try and save, or, capital that we're trying to invest, which is somebody's saved money, are continually having that value diluted because these people keep printing more of it. And so, and of course, obviously, that's why you've got to get money that's outside the system, silver, gold, Bitcoin, right? So I don't think, I think they will try a CBDC, and I think it'll be a big flop. That's my prediction. I mean, it might survive because they might say, oh, we'll give you a discount if you pay your money in CBDC. And there might be a part of the population, they say, well, if you want to get your universal basic income, you got to sign up for the CBDC. Well, free money? Yeah, everyone will sign up for that. Oh, yeah. But anybody with half a brain will quickly realize that it's just another form of fiat. And if they get their money in their CBDC and they're able to, I mean, it's like, I know people who got their stimmy checks and they said, okay, I'm taking this down to the coin dealer. Yeah. Thank you very much for this free money, but I'm going to change it in for something that I know you can't print, right?
I know. I remember those memes going around back then. It was like, hey, you just gave me fake money. I turned it into real money.
Exactly. Right. And I mean, people aren't stupid. And that really, Kai, that's the bottom line issue here, that we all need to, in my opinion, work as hard as we can to kind of educate friends and family, get them watching videos, get them thinking about it, get them reading books, etc. We got to turn everybody into an Austrian economist so that they kind of understand that, this system is going in the wrong direction. It's broken. And if you're saving in dollar terms, that's not going to work very well. You gotta save in non-dollar terms, because the dollar is going to get, diluted enormously, right?
Absolutely. Like, Larry, I can't let you go without asking, but do you fear recession in the next 12 months?
Do I see a recession in the next 12 months?
Yeah, I do. Fear it? Yeah.
Do I fear it? Yes and no. I don't think it's going to be an incredibly severe recession. I could be wrong about that, but I don't think it's going to be incredibly severe. I think we're gonna have a real case of stagflation, where, I remember the 70s, actually. The 70s it wasn't like the economy totally fell apart. It just was really punk. Nobody was making much money, and the cost of everything just kept going up. You know what I mean? And it's a dangerous combination. I mean, businesses, I don't think you see wide. I mean, unless Powell keeps rates. Look, if Powell takes interest rates to 10%, we're going to have a depression. Okay. I mean, banks are going to break. It's going to really start to unwind, and we are going to have a depression. But I'm highly confident, based on their mandates, stated and unstated, and their understanding of the situation, that they will not be that stupid. That while they're playing a game of chicken now with the market, saying, okay, we got to get inflation under control, raising it, but ultimately, when push comes to shove, and it looks like the market and the economy is going to go over the cliff, they're going to print. They're going to lighten up. They're going to be accommodative. They're going to print. And what that'll mean is the economy will hang in there, but there'll be more inflation, because the printing will lead to inflation. So
this comes back.
That's kind of how I see it. We muddle along with an inflationary bias, and not a lot of real growth, but not necessarily a total collapse. I mean, the total collapse is only if they take rates to 10%. And I can't believe they're going to be that stupid. I mean, I say that and I kind of laugh. Never put anything past them. Maybe they are that stupid, right?
You
We don't
never know.
know.
You never know.
You never know,
If
right?
you were to put 2023 into one word, do you have one word for us that would sort of summarize it for you?
Yeah, I would say buckle up. I mean, I think it's been a little bit of a kind of a calm in the storm. I mean, we had COVID, we had 2020, we had the market break. I mean, this year's been kind of chopping around. I think a lot of people, the market's kind of held in there better than thought. We're only down 20%. Unemployment, we're seeing some layoffs, but it's not serious. I mean, I think what they've done, there's a lag between what they've done and the impact of what they've done. And I think the impact of what they've done is going to really start to show up. And as it does, these things, I mean, it's a psychological issue, and these things they're kind of like dominoes. One of them will fall over, and then another will fall over, and then pretty soon everybody will be saying, holy shit, we got a real problem here. Right. And that's what's going to drive gold and silver higher. That's what's going to drive the market lower. And by the way, look, the stock market's a big deal because, I mean, people have their savings and their retirement in the stock market. If they lose their, if their retirement savings go down another 20%, people are going to feel poor and they are going to cut back. And so, yeah, I mean, that's a recession. I mean, it's not necessarily an incredibly deep recession, until it starts to filter through to employment. But it could get there. It could certainly get there. But I think long before it gets to the dire straits kind of view, they will have pivoted, and that'll be a shot in the arm that'll kind of keep people thinking, oh, okay, well, now they pivoted, it's going to be okay, blah, blah, blah. The inflation prints will have come down. They think, well, maybe inflation will get high in the future. We're not going to worry about it too much. And, and of course, 6 months later, the inflation will be the problem again. But, you know,
No,
I mean,
absolutely.
they're driving a clown car. I mean,
Yeah.
they've got two rails, deflation and inflation, and they're bouncing off the rails.
It's really interesting because it really sort of works together with the thesis Rick Rule put out. Is like we've probably got 6 months to buy in the gold and silver space before things will really take off potentially. Based
Yeah,
on
I
what you're
think I
saying,
think
like there's a bit of a lag there, and
yeah,
it could be that fresh jab into the arm, like either fresh money, a hard pivot, right? And
I think that's
yeah,
right. I think that's right. I mean, yeah, I wouldn't wait 6 months. I mean, the best bargains are right here and right now. And I've already had things. I've had several things that I bought, last few months pop up 20 or 30%. I mean, these charts are starting to look really constructive. I mean, look, in terms of piling on and maybe using a little leverage and going for the really risky shit, yeah, we're a little too early. I mean, I'd like to see us go through a few more levels. I mean, Don Durrett, who I'm sure you know, and I respect a lot. He's looking at all this, and he thinks we got one more check in gold, silver, in the mining shares, and he thinks it comes with the U.S. stock market falling apart in the first half of this year. I feel pretty strongly. I agree with him on that. I think the U.S. I mean, that's deviant perception. I think everybody thinks the stock market's going to be okay in 2023. I don't. I think 2023 is going to be another bad year for the stock market. And it's the year where the buy the dip people who today are kind of cautiously optimistic. Well, it was a bad year. I'm down 20%, but we've been here before. I got to buy it. I got to hang on. I think we start going down another 10, 15, 30%. It really starts to bite. And they're thinking, shit, this is money I need I can't take anymore. I got to get out of here. Do you know what I mean? And then it starts to get serious. And so if we had a hard stock market slide of 20 or 30% sometime in the next 6 months, there's a chance. I mean, as all correlations go to one in a real hard sell-off. People would sell gold, silver, and gold and silver mining companies too. Don thinks we have one more of those coming. I'm not sure I agree. I kind of think we've seen the bottom, but either way, we're even if we do have one of those, I don't think he thinks we necessarily make a new low. I think he just thinks we get a gut check. So, look, with all these things, I mean, in Bitcoin too, and I advise, again, if you don't use leverage, you've got a 5-year window, which I do. I mean, I'm all my investments, I'm prepared to hold them for 5 years. And you are buying on your side of the table, which is to say things are cheap, right now. I mean, could they get 10% cheaper? Yeah, but it wouldn't cause me to sell. You dollar cost average, right? I mean, if I were starting fresh right now and I were trying to build a gold mining portfolio, and I had $100, I mean, I'd spend $20 now, and I'd probably spend $20 in another month. I'd spend $20 a month after that. I just kind of average in over the next year, because I know that 2 or 3 years from now, as these macro problems that we're talking about become very clear, and the additional printing becomes very clear to get, things going again, people are going to come to the conclusion that we've all come to, which is they can't ever stop printing, and they're debasing these currencies, and you have to own things that aren't debasable. Gold, silver mining stocks are at the top of the list, right?
Fantastic.
So,
Yeah, absolutely. Larry, what a great conversation.
well,
We
thank
got to
you. No,
wrap it
I
up
always
here.
enjoy talking
That
to you,
was,
Kai.
yeah, it was fantastic. Really looking forward to 2023 now here in the gold and silver space, obviously. So 2022 was a bit rough on the portfolio.
It
So I
sure
couldn't.
was. No, this year was no fun, but look, we've seen these before. I mean, I would remind people that 2019, example, my phone was up 97%, and 2021 or 2020 was up 120%. So, you take the 30% drawdowns, and I mean, I think a lot of gold stocks are going to be 2 to 5 baggers, in the next 2 years, easily.
Absolutely.
Easily.
I agree with you on
So
that.
it makes it a little easier if, stick to the quality. It makes it a little easier to take it on the chin like we have this year, which is, it's no fun for sure.
Absolutely not. No, but let's wrap this up here. I really
Okay.
appreciate your time, and I'm not sure what the saying is in Germany. We call it zwischen den Jahren, between Christmas and New Year's is a special time. It's
Uh,
like it's in between. We call it in between years.
there you
So
go.
yeah. So happy New Year, Larry. All the
Happy
best
New
to
Year
you
to
in
you, Kai. Great
2023.
talking to you. Look forward to meeting with you again in person. I'm sure we will.
Probably. Yeah, I'm not sure if you're coming up to Vancouver in January. If you're coming out,
Possibly. Yeah, it's on the
then
calendar. Yeah, possibly.
we'll see if we can connect there, and we'll
Sounds
sit
great.
down and see how things are shaping up there. Fantastic, Larry. All the best. Happy New Year, and
Likewise. Happy
good
New
luck to
Year.
you. Everybody else, thank you so much for tuning in. This was a great conversation with Larry Lepard here. What do you think? What do you think 2023 is going to be? Do we still have a window of buying opportunity here? Is it closing? How are you positioning? Do you fear recession? Are you still in the main markets? Let us know in the comments. We want to hear from you. Happy to discuss further. And of course, subscribe and like this video. Thank you so much. We'll be back with lots more great guests, as I mentioned in the intro. So make sure to subscribe to the channel not to miss anything. Thank you so much.